Welcome to AccountingCorner.org channel.
In this video, we will explore equity concept. Equity represents financial means provided by the shareholders of the business to be used to acquire assets and also to finance business activities. Alternatively, equity can be defined as an amount of assets which remains for shareholders after all liabilities of the business have been paid off. Equity does not have maturity date, which means that there is no due date when these money have to be paid back to shareholders.
Equity consists of the following parts: common stock, preferred stock, capital in excess of par value, retained earnings.
There are two types of stock: common stock, preferred stock. Features of common stock are the following. It has voting rights. There is no guarantee that dividends will be paid. Common stockholders have the first right to buy additional shares if they are issued. Features of preferred stock are the following. Preferred stockholders do not have any voting rights. Preferred stock implies a guarantee of dividends. This means fixed percentage or amount of dividends to be paid for a year. Preferred stockholders, compared to common stockholders, have priority right to get back part of the assets in case of business liquidation.
In certain cases, when business is established and shareholders invest more money than par value of the shares, excess amount is called capital in excess of par. It is a separate part of equity. When share capital is paid, it is recorded as debit to cash and credit to common stock. Capital in excess of par is recorded in a separate account. Also, it is a separate line on the balance sheet.
Retained earnings represent profit, which is accumulated in the business and not yet distributed to the shareholders. Retained earnings can be negative in case there is accumulated loss, which was not covered by investments from shareholders. Retained earnings balance changes each year. Net profit, which is not distributed to shareholders, or net loss from the income statement, is transferred to the balance sheet retained earnings caption. This is a relation between the income statement and balance sheet.
Another concept closely related to equity is dividends. Dividends represent distribution of net profit to shareholders. In case the company declares dividends, it does not necessarily mean that they will be paid on the same date. In such case, there is an obligation to pay them later. When dividends are declared, the following entry is made. Debit: retained earnings, which is a decrease in retained earnings. Credit: dividends payable, which is a liability to the shareholders to pay dividends at some time in the future. Declaring dividends is not a liquidation or closure of the business. It is a distribution of the accumulated profit. The following entry is made when payable dividends are paid. Debit: dividends payable. Credit: cash.
Give us thumbs up and subscribe to our channel for more tips on finance and accounting.
Visit AccountingCorner.org for free downloads on finance and accounting.